Hello and welcome to another Deep Value video. Today taking an in-depth look at Walmart Incorporated, ticker symbol WMT. We'll dive into financial metrics, assess the company's growth, and ultimately try to find its fair buy price. Walmart Incorporated, formerly Walmart Stores Incorporated, is an American multinational retail corporation that operates a chain of hypermarkets, also called supercenters, discount department stores, and grocery stores in the United States and 23 other countries. As of the 18th of November 2024, the stock is priced at $84.2 with a market cap of 677 billion. Now let's dive into some key valuation metrics. The price to earnings ratio stands at 43.4, significantly above the median P over the past 10 years, which is 26.4, and the price to cash flow ratio is 20. Over the past 5 years, the company's revenue has grown by 23.7%, and its bottom line has increased by 4.2%. In terms of earnings per share, there has been a growth of 10.4%, and notably, the number of common shares outstanding is 8.1 billion, a minus 5.9% change over a period. Now, let's assess the company's liquidity and solvency. The interest coverage ratio is 10.2, indicating the company's solid ability to handle its debt obligations. The quick ratio of a quick measure of the company's short-term liquidity is 0.22. Now, this is very low, but they are in an inventory-heavy business. They are in retail, so this is a specific case where this doesn't really matter as much. So we can go over it. Additionally, the long-term debt equity ratio is 0.41 and the total debt equity ratio is 0.46, both suggesting a moderate debt load. Shifting to the cash flow statement, cash from operations stands at 45.7 billion, reflecting a growth of 41.5%. Cash from investing activities is minus 21.3 billion, with a plus 130.9% change, while financing activities are at minus 13.4 billion, showing a minus 6.2% change over the same period. CapEx has increased by 92.5% and free cash flow has grown by 3.9% to 15.1 billion. Moving forward, let's look at the return metrics to see how well the company is utilizing its resources. The return on equity is 17.5%, the return on investment is 21.6%, the return on assets is 6.1%, and the return on invested capital stands at 11.5%. Finally, let's find acceptable buy price. The first method is conducting a discounted cash flow analysis. By using a discount rate of 9%, a revenue growth rate of 3% for 10 years, and a perpetuity growth rate of 2%, we get a fair value of $47. Secondly, using a multiples valuation of 20 times earnings, operating cash flow, and 25 times free cash flow, we get a fair value of $65.5. And finally, the analyst price target is $89.3. Putting it all together, we get an intrinsic value of $67.3, and using a 15% margin of safety, we get an acceptable buy price of $57.19, suggesting that the stock at the current levels is overvalued. To wrap up my analysis, I rate Walmart as a hold. Now, this isn't really even a hold. This is most probably a sell, but I believe that as of now, they're not overvalued enough to warrant a sell. They're probably a sell at about $90. And for all the Walmart backholders out there who are asking why is this a sell, well, are you really willing to pay a 40 times price to earnings for a company that's barely growing? I mean, sure, they could cut their capex, which is going like insane, and the free cash flow will grow a lot, but this would be a one-time move which will only uh, relieve their free cash flow for a few years, but their free cash flow is, of course, a product of their revenue increasing. And the revenue is not really projected to increase at all for the next 10 years. I mean, 3%, think about it. The Fed's inflation target is 2%. If they go at 3%, that's a 1% CAGR for 10 years. I mean, that's nothing. Are you really going to pay $40 per every dollar of profit, so 40 times earnings, for a company that's growing at 1% CAGR? I mean, sure, you could do it, but I don't know. This is not really something that I would personally do. Even if you look at other overvalued companies on the market, there are still so many more other than Walmart that are just as overvalued, but they are still growing much more. So they still you're overpaying, but for a company that's actually growing. Walmart is a company where you're paying a premium for nothing. You're paying a premium for the possibility of a 1 to 2% yearly growth on your stock. Now, if you did not understand what I've just said, let's put it another way. If you have two companies and you are both paying 40 times earning, 40 times operating cash flow, 50 times free cash flow for both of them. Now, which one would you choose? The one going at 10% annually, 8 to 10%, or the one going 3%, knowing that inflation is 2%? And another point, usually multiples contract very fast on companies that don't grow. Now, maybe for the time being, their multiples will stay for 1 or 2 years, but do you really think they will stay at these multiples at 40 times earnings for that much time? Are you really not thinking that maybe I don't know, next year, in the next 2 to 3 years, their multiples will collapse? Even 20 times earnings is absurd for a company that's barely growing. I mean, that's retarded. Uh, as for what I would think would be a good price, then I don't know, 50 to $55 would probably be where. Yeah, no, actually 50 dollars would be my buy price. Now, I'm sorry if I offended the Walmart bag holders, but yeah, it's absurd. Anyone thinking this stock is a buy, it has literal, should not really watch investing videos because they're not an investor, they're a speculator, as Benjamin Graham put it. Um, yeah, thank you for watching. Um, if you found this video helpful, please like and subscribe for more deep analysis, and also check out my investing blog featuring in-depth analysis from the link in the description below. See you in the next video. Bye.